Hello and a warm welcome to today's webinar. The topic of today is measuring and managing customer profitability. This webinar is offered jointly by the Performance Management Shared Interest Group and the IMA Switzerland chapter. A couple of housekeeping rules for today. You'll be muted upon entry. You can use the Q&A function to ask any questions. If we may not be able to answer the questions today, include your email address and we'll make sure that that Gary answers your questions at a later date. Note as well that next week we'll have a roundtable discussion, which is an informal way where we can interact with Gary and other members of the shared interest group to also discuss any questions, but also any input you may have. Feel free to use the chat as well to interact with me during the session or other attendees. There'll be poll questions appearing throughout the session. To gain your CPE credits, you'll need to answer 3 out of the 4 polling questions. And you can find materials and links to the SIG page in the related content section. There is a survey at the end of the webinar, and we'll be very thankful if you can fill it out. And your CPE certificate will be mailed to you automatically. Very quick word about the shared interest group. This is a free group within IMA. Also, if you're not a member, you can join us. Use the QR code on the left to join our SIG page, and you can also follow us on LinkedIn with the QR code on the right. I'll send the link as well in the chat right after. But without further ado, our presenter of today is Gary Cokins. Gary, the floor is yours.
Thanks, Hessel. And it's a pleasure to be a member of the IMA Performance Management SIG. I think we've been together for 3 years. Regarding the follow-up, because this is going to be a long presentation, there may not be that much time at the end. That group of the follow-up group will be next Tuesday. Hessel and others will be able to give you more information. If you have direct questions for me, please write my email address down. There it is, gcokins@garycokins.com, and just send me your questions or comments directly there. So let's get going. Who am I? Gary Cokins. I received my Bachelor of Science in Industrial Engineering and Operations Research from Cornell University, 1971. My MBA from the Northwestern University Kellogg School of Management, 74. If you're doing the math, I am 76 years old, but I feel like I'm 46. My career was pretty much in 3 segments. My first decade, a large manufacturing conglomerate, FMC Corporation, then many years with consulting, 7 years with Deloitte, 5 years with KPMG, 5 years with Electronic Data Systems, that's now part of HP. And then for 16 years, I was with SAS. People, what's SAS? Scandinavian Airlines? No, SAS is actually the world's largest privately owned software vendor, 15,000 employees that specializes in analytics. I retired from SAS 8 years ago. Why are those books there? Well, you'll know a little bit more. I believe careers have a lot more to do with luck and circumstances than being smart and competent. I had a couple of lucky breaks. One of them, when I was like 27 years old, I wound up being a division controller at FMC, but then I had the opportunity to get recruited by Deloitte, and I spent most of my career in the CFO and accounting space. My other big break, and I'll talk about it in a second, is that in 1988, KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. Many of you recognize his name from the Balanced Scorecard, but he did the pioneering work in activity-based costing. So I got recruited from Deloitte to KPMG. I was trained. I then implemented ABC many times. I wrote a book, and that led to all these other books. Incidentally, you don't need to purchase the books. Don't attack me or criticize me. If you go to wiley.com, W-I-L-E-Y, chapter 1 for the books is typically a free PDF download. So who will benefit from this presentation? Managers who have previously struggled at promoting the measurement and reporting of product, channel, and customer profitability into their decision support systems. Managers who intend to champion profitability analysis techniques and need a compelling call to action. And the reason I have champion in quotation marks It's been my observation that although it's nice for senior executives to advocate and support new ideas and innovations, oftentimes they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3, 4 levels down in the organization chart who basically ask, how long do we want to perpetuate using stale or arcane or flawed information? And they're the ones that'll do a proof of concept or a pilot project to demonstrate to their work colleagues, the executives above them, this is the way to go. So if you're earlier in your career or lower in the chart, that's fine. I like presenting to you. I love this cartoon, drowning in data, but starving for information. You've got this poor beleaguered clerk, sad, shoulders hunched, paper all around him. And the supervisor in the doorway to the left is asking him, looks like you've got all the data. What's the holdup? I gave you the request this morning. How come you don't have the answer this afternoon? And the message here is there's a difference between data and information. Data is typically collected transactionally, purchase orders, invoices, but you convert the data into information, and you'll see how that's done for measuring customer profitability. I also like to start with these 3 questions. What, so what, then what? So imagine that you actually implement the method I'm going to describe. You're not done. Now you're going to know things. Then you're going to basically ask what's relevant. The real important question is then what? What's the impact in the future? And that will be a separate webinar on driver-based budgeting, rolling financial forecasts, and the future view. So my agenda, I'm first going to have to give some basics on activity-based costing because it's fundamental to how to measure customer profitability. I'm going to describe a quick way that you can actually implement ABC in 2 weeks, not 3 months, 6 months. Then we'll actually get to the guts of this. How do you calculate it? And then I'm going to end at the end. I'm going to conclude with a frustration I have. What's taking so long for organizations to implement these progressive methods? So let's start with the basics, but now we have the first of the polling questions. Which business action do you feel has your organization received the most financial impact from? A, strategic planning and execution. B, product cost visibility and cost driver behavior. Forecasting, planning, budgeting, rolling financial forecast. D, enterprise risk management. E, customer profitability reporting and analysis. F, process improvement like lean management and quality management. Move fast here. Try to do it in the next 30 seconds. Those of you who want your CPE hours. Okay, looks like those of you who basically want to answer the poll have. Okay, and the largest number one is the biggest impact, strategic planning and its execution. That involves strategy management with the balanced scorecard and strategy maps, KPIs. That's another webinar that we have done for the PMs, or you can send me an email if you want to know more about that. I'll send you some articles I've authored on that topic. So some basics on accounting, direct versus absorption costing. Ideally, all costs should be directly charged. But as the variety, complexity, and technology increases, more costs become indirect and shared. And what you're seeing here is sort of a continuum. The highest form of direct costing is project accounting, but it only applies when you're doing a one-of-a-kind, like a make-to-order or building a satellite. Traditionally, for manufacturing, we have standard costing. It takes labor reporting, and then we have these routings and bills of material. Even service organizations have a form of this. ABC, I refer to it as sort of like the poor person's, standard costing system. You'll see what I mean by that. We can get that labor reporting really quickly using rapid prototyping. We use drivers. The real message to this slide is the bad thing is allocations, spreading the allocation like butter across bread. I'll get to that in a second. Again, one of the reasons I became somewhat expert on ABC is when I got trained by Professor Kaplan. There is a photograph of him. He really broke through the awareness of activity-based costing with the book. I think it was in the 1970s, and there's the book cover, Relevance Lost. So here's a simple way to understand them at ABC. Imagine you go to a restaurant with 3 other friends. You order a little salad. The other 3 order the most expensive item on the menu. At the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines for service organizations also feel when the accountants take this substantially large indirect expense, typically called overhead, and they allocate it like spreading butter across bread using cost allocations like in manufacturing, number of labor hours or number of sales dollars or headcount per department. None of those cost allocation factors reflect the true realistic consumption of those indirect expenses and the activities that belong to them. So what ABC does is basically it decomposes those indirect costs into multiple pools, and it traces them with a cause and effect relationship to get a far more accurate answer. And so the easy answer of this is it's if the waitress or waiter brings 4 individual checks, you only pay for what you consume. Now, the reason there's become interest over the last 50 years, 75 years in ABC has to do with this diagram. It has the 3 universal components of any organization's expense and cost structure: the overhead indirect expense, the direct material for manufacturers, and the direct recurring labor. I use recurring labor because, service organizations like banks, insurance companies, you see a table rack, oh, it's manufacturing. No, this is universal and applies to any organization. Now, why is the indirect displacing the direct? Some of you say, well, automation, machinery, that's secondary. The main reason that the indirect expense is displacing the direct is because over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more sizes, more ranges, banks, more type of depository accounts, insurance companies, more types of policies. The point is this: whenever you increase the diversity and variation of the outputs, it basically creates complexity. And the complexity causes the need for more and more indirect expense. So 50 years ago, when your company had homogeneous products, maybe just 2 colors, not 50 colors, it was a thin veneer of indirect. All right, most of the expenses were direct and accurate. You could butter spread it. That's not the case today. We need to basically be more efficient. Now, the problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this statement: salary, equipment, travel. But the problem is when managers receive this report, they ask themselves, how much insight and understanding do I get to the cost that I can influence and control? And their answer is none. I like to say when managers get this kind of report, they are either happy or sad, but they're rarely any smarter. What ABC does is it makes them smarter. And the way it does it is it translates that same 914,000. I know so many of you from Europe, you could use euros, dollars, whatever your currency. It translates it exactly, but into the language of work. My example here: key scan claims, analyze claims, suspend claims. Notice I'm using the back office of an insurance company. It's kind of a factory too. And then we reassign those activity costs to the product, service lines, channels, and customers using activity drivers, just like the waiter or waitress in the restaurant, based on the unique consumption. Okay. Now, it isn't as simple as of what I just showed you. I've rotated the previous slide 90 degrees. It's not as simple, oh, we take our ledger expenses, put them into these activity cost pools, and assign them to products. No, there are support departments that support other support departments that ultimately support the frontline departments that interact with customers, make products, deliver services. it needs to be a multiple stage costing. Now, I want to warn you, the next slide is going to look complex, but I'm going to be able to take care of you because the slide after, I'm going to give you a link to a statement of management accounting I wrote for the Institute of Management Accounting. You can read it at your own leisure. But here's the way it works. It has those same three universal components of expenses and costs. We trace the ledger expenses into the activities. Now, notice in the activities, you've got people activities and equipment activities. Men and women run machines. Machines make product. Men and women drive buses. Buses deliver passengers. So assets also do activities. When we get to the bottom, I call this the predator food chain. Large mammals eat small mammals eat plants. We ultimately will get to the customers. The customers consume the products, but notice there's a couple of red boxes going from the activities directly to the customers. It's not about making the product. It's about things like channel distribution expenses, marketing expenses, and selling expenses. We'll get to that. Now, there are going to be some expenses that have nothing to do with interacting with customers. We call those business sustaining costs. Things like the legal department or when the accounting department is closing the books. It's not traceable. It's typically about 10% of the cost. So we trace them to a cost object like senior management because they need those reports. The message here is costing is modeling. Costing is not T accounts and journal entries, okay? Direct costs, not broken, but IT can basically fix on that. I mentioned to you, I went through that slide fast. If you're interested in reading more about it, when you get these slides, if you click on or put in that IMA net down there, it's a statement of management accounting that I authored. It'll take you through that and actually the rest of this presentation as well. Now, what's the result when you do ABC? With this diagram, the vertical axis is the percent error. So the horizontal line would be that traditional costing with butter spreading of the butter across bread. The backwards curvy, if you will, S curve, that's the ABC. So notice when we're way to the left, typically the simple products, they've been subsidized and they're way over costed. So they don't really cost as much as you're calculating when you use that butter spreading. Far to the right, though, are the complex products and services, and they've been undercosted. So, they actually are more profitable than what it appears to be. Now, the consequences is significant. For those left side, the overcosted, the problem there is competitors will recognize that, well, you overcosted it, you marked it up maybe 5% for pricing, but their costs are far lower, so they're going to price below you and steal some of your market share. To the right side, it's even more terrible. The sales force is of the impression that some of the products or services are very profitable. They're not very profitable. Some are unprofitable, but they're selling more and more. So the more that they sell, the more you lose money. That's the impact. Now, here's another impact from ABC, and you're looking at real data here of a company. The vertical axis is the net revenues minus the properly traced ABC costs. The horizontal axis is the cumulative buildup of the profit with ABC, but it's rank ordered from the most profitable product to the second most profitable product and so forth. Notice the very last data point at the right will exactly reconcile with the profit and loss statement. So for this company, they had roughly 30 million in sales, 28 in expenses to net out at 2. But there's always organization shock when they see this graph. These graphs are nicknamed whale curves because they look like a humpback whale. In this company, they had roughly $8 million of unrealized profit on 3/4 of their most profitable products. They lost $6 million on the remainder to net out at 2. They can't believe it because their belief system is it's this little blue line, which is from that butter spreading, because all of that broad averages of the butter spreading is crushing, suppressing any accuracy. And ABC, detecting all that diversity and variation using the multi-stage cost assignment, creates the upper curve. The message here is it's fact-based data. The upper curve is fact-based data. If you remember anything from my webinar, remember this. In the absence of facts, anybody's opinion is a good one. In the absence of facts, Anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of your boss or the boss of their boss. So to the degree your bosses are making decisions on gut feel or intuition or flawed and misleading information like the blue line, your organization is at risk. Notice here's a second graph of another company with a whale curve. In their case, they were losing $500,000, but the whale curve showed they were making roughly almost $5 million on 60% of their products and lost on the remainder. Incidentally, the reason these two graphs look so crummy is they are like 30 years old. These were my first two engagements on ABC with KPMG in the 1980s. And now we're in the 2020, 40 years since. I love this cartoon. You've got this signboard. Simple but wrong to the left, complex but right to the right. Notice how many are taking the left path. You know, that's that butter spreading. It's convenient to use cost allocation factors like number of units produced, sales dollars, headcount. It's convenient. It is a little more of a challenge to do the activity-based costing, but it's correct. And look how few are doing it. And I have empirical evidence. Very few organizations are actually using ABC. And here we are in the 1960s, even though Kaplan wrote about it 60 or many years ago. We're at our next polling question. What do you use as your primary reporting system? A, enterprise performance management systems. B, enterprise resource planning software. C, business intelligence tools, analytics. D, Excel spreadsheets. E, other. Try to answer quickly. We got to move fast.
Hi, Gary. Can I pause you quickly there? We got a lot of feedback from the audience that they did not see the first question. So let's give people a little bit of time to answer this one.
Okay.
And for those people who said they did not see the first question, can you please write in the chat if you see the question now? And I see that a lot of people answered, so it seems to work, but if someone can quickly write in the chat if it works.
Yeah, we're at 90% of the people have submitted, and some of them aren't looking for CPEs. So I'm going to go ahead, and you can handle that hustle on with those people.
And they see it now, so that's great. Okay, thanks, Gary.
Okay, no surprise, almost half are using ERP software like SAP or Oracle, Infor, and the like. So let's move on. Now, many of you are saying to yourself, Gary, you're starting to persuade me we should be doing ABC, but oh golly, it would be a mudslide of data. Every employee would have to fill out a daily timesheet. They hate timesheets. We'd have 500 activities in that system. It'd be so complex. No one would understand it. It'd be difficult to basically update it and so forth. Those are all basically ways people have thought about it, but they are misconceptions. There's a way to implement ABC in 2 weeks. And it's a technique that I learned and actually created called rapid prototyping with iterations. What we do, and you're more than welcome to contact me after the webinar or this week, you get 5 or 6 cross-functional employees in a room. We basically ask them, what are the 2 or 3 activities for your cost center? Verb, adjective, noun. Okay. Then just do some percentage splits of the number of employees in that cost center, 30, 30, 40, 10, 10, 80, 100%, everything normalized on 100%. Okay. And then we can basically move those. We're talking only about 10 or 20 activities in this model 0. And then they can trace it. We can get it kind of reasonable level to maybe product families, not to individual products. Good enough. All right. The next morning, we bring in the other line managers and the executives. They see what was done. The light bulbs go on for all of them. Oh, that's how we get rid of that butter spreading. Oh, that's how we could do benchmarking with apples and apples, not apples and oranges, and so forth. They get buy-in, And then we basically ask them, what will you do with this information? Because in 2 weeks, we're going to do a couple of iterations. It's going to be a permanent, repeatable production system, good enough to use. So we've got their buy-in, And we also ask them, what are you going to use the information for? Oh, I could validate pricing. We want to make sure that once the ABC system is complete, they're going to actually use it for decision making. Make your mistakes early and often, not later when the system is too hard to change. Part of the problem is the consultants, and I was one, they like billable hours. So when they're going to do an ABC implementation, they might want to take 2 months, 3 months. They want to have a detailed, very granular ABC system. You don't need to be that detailed. The reason rapid prototyping works has to do with this graph. The vertical axis is the accuracy of what you may want to know. Let's just say your product costs or unit service line costs. The horizontal axis is the level of administrative effort to collect the data, calculate the data, report the data. Notice you'll always get an asymptotic curve that goes up relatively quickly and then levels out. With rapid prototyping, notice the slope on that curve goes up really quickly. We're at 90% accuracy with just a little bit of effort. So it's not a big deal to continue on. In fact, it's just a waste of time to go further on. It makes it good enough. Now, the problem is, yes, it's true, if you get the financial reporting for the government regulatory agencies wrong, you go to jail. But if you get the management accounting information wrong, you don't go to jail. So you don't have to have super accuracy, just to be good enough to start making better decisions, certainly compared to the butter spreading. Benefits from rapid prototyping: accelerated learning. Everybody gets it. It solves that thorny leveling problem. Oh, how many activities are we going to have? 500, 90, typically it just levels out. It prevents that over-engineering of the initial ABC such that no one can understand it. There is that peer group. We ask the people in the room, when it's done, how will you use the information? In general, it replaces all their misconceptions of ABC, that it doesn't work, the black eye of ABC. It replaces it with reality. And you get a higher ROI because you start using it for decisions quickly. And about ROI theory, the sooner you basically get returns from an investment, the higher the ROI. Now, let's get to the topic: measuring and managing customer profitability. Which caused interest is a shift from being product-centric to being customer-centric. The emphasis will be more on the economics, measuring customer profitability. So the value of a company is a function of the value from its customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a couple of problems here. The accountants are not measuring any of this. They're stopping at the product gross profit margin line. Products and standard lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making products or delivering services, standard services, like selling expenses, channel distribution expenses, marketing expenses? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture, meaning the bottom half of the income statement. And I'm going to make a case it's more important than the top half. Visually, if this entire rectangle, let's say, was the expenses for January, the accountants are only calculating for the shaded area. They're not including the white space, distribution, sales and marketing, general, and so forth. So why does this matter? 4 reasons. I call these the perfect storm. 1, customer retention. It's relatively much more expensive to acquire a new customer than to retain an existing one. That's a no-brainer because existing customers, they're already acquired, so they're a sunk cost. So if you know much about decision theory, when you're basically doing financial, if you will, analysis, you don't include sunk costs in that analysis. 2, sources of a competitive advantage. As products and standard service lines become more commodity-like, then the shift is towards the service differentiation. So that's not just the products and service line costs, that's the different types of services. 3, customer relationships, one-to-one marketing. There are 2 gurus in the marketing world, Don Pepper and Martha Rogers, and they've hailed that technology as is the enabler to do 2 things: identify customer segments and then start tailoring the marketing offers, deals, coupons, price discounts, and the like. And then finally, the power shift. The internet is shifting power irreversibly from sellers to buyers. And I don't mean just you and your family, purchasing things on the internet. Today, purchasing agents in a company with a click of a mouse can look at 10 competitors and all of their pricing. And this is a one-time event, the internet happening in our lifetime. So when you basically look at all those 4s, it builds a strong case. We need to do customer profitability reporting. Now we have a different problem: angel customers and demon customers. What do I mean by that? Every company has high and low maintenance customers. So examples of a high maintenance customer: they're always changing delivery schedules, always demanding special, not standard product, always returning goods, always calling help desk. The low maintenance customers, we love them. Those are angels. They're doing none of that up above. Always basically on delivery schedule, only buy standard, never return goods, never call help desk. If those 2 types of customers at the polar opposites bought the same volume, same price, same mix, they're not equally profitable because the high maintenance, those demon customers, are costing you a lot more money. So the message here is sales volume is not synonymous or equivalent to the profit from a customer. Now, this diagram, I'm decomposing the multiple stage cost assignment. The diagram is in that 30-page statement of management accounting from the IMA. But the message here is, as we go from left to right, the activities coming in, sorry, I got to go back. What's happening is the profit is being eroded layer by layer by layer by layer. And so this diagram allows us to create a profit and loss income statement where all of the margins, contribution profit margins, are like an onion skin, layer by layer by layer. So in this example, notice this fictitious customer XYZ had a 30% composite gross profit margin on the products. But between the 30 and the 8 below, 22 more points of profit are eroded, nothing to do with making the products or the standard services, but all with those, if you will, distribution, marketing, and selling expenses. So if you calculate this for every single one of your customers, you can put them on a grid that looks like this, where each of the intersection circles is a customer. Now the vertical axis is that product mix, gross profit margin, or service mix. The horizontal axis is that cost to serve, with the devil's way to the right, high, impact, high demanding, low on the left. And now things become obvious. The most unprofitable customers are in the bottom right because they're buying low profit margin products from you and they're difficult and challenging to serve. The most profitable customers are in the upper left because they're buying high margin products and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left. And that would basically be a whole other presentation on what those techniques would be. But one of them may be fee-based. Look at airlines. They charge you fees for baggage. They charge you if you want to move from a middle seat to another seat. Banks have different fees for basically depository accounts. So that's just one way. Another way is cross-selling and upselling. If they buy a set of golf clubs, can I sell them a t-shirt? If they buy the t-shirt, can I buy them a second t-shirt? Here's another way of looking at the same data. Now the circles are replaced with squares. The vertical axis is the level of profitability of a customer. The horizontal axis is the sales from that customer. Now you notice to the furthest right, we've got the most profitable customer. Above that is even a few more profitable with less sales. But look at all of the customers in the squares in the triangle underneath. They're pretty significant, substantial sales, but they're unprofitable. So we are at our next polling question. Which one of these does not describe activity-based costing? A, it traces expenses into costs consumed by products and customers. B, it calculates expense consumption based on costing's causality principle. C, it requires key performance indicators. D, it is difficult to calculate with a spreadsheet. E, it can report different costs than used for GAAP, generally accepted accounting principles, for external finance reporting. Let's go. One of those does not describe activity-based costing. All right. Keep going. Almost all of you are in.
Let's give it a bit of time, Gary, until everyone, until the number stops moving. There's still a few people who missed the second polling question.
Yeah. No, we're almost at the 90%, Hessel, and some of them are not bothering it because they're not looking for CPE hours. So we're at the 90%. I'm moving on. So, well, the correct answer is actually C, the middle one, requires key performance indicators. And incidentally, you don't get penalized for right or wrong answers. You just have to have CPE questions. But the output of an ABC system can provide KPIs for a strategy map and balance scorecard for performance management. So let's go on. What's really happening here is there's a shift in the CFO's emphasis. The CFO, typically what they do is, they pound on operations to lower their costs. No, they have to look at a different way. The CFO must now help the sales and marketing to target the type of customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for shareholders and owners. This means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back? And which types of customers are not attractive? Those dumb demons, the high maintenance ones. And then for the customers that are attractive, the next question is, how much should we optimally spend attracting, retaining, growing, or recovering each of the micro segments? And now I use micro segments because the marketing people are very good. They just don't have, like 4 squares, old, young, male, female. They may have 15 or 20 types of micro segments, pools and patios, wealthy people with big backyards, and all sorts of other subsegments. But the reason it's an optimization problem is because if we wind up spending too well, I'll get to that, I think, in a second. Yeah, here's the reason, explanation. I didn't mention the subtitle of the book, Angel and Customer book, but look at what it says. Discover which type of customer is which and turbocharge your stock price. So you can destroy shareholder wealth creation in 2 ways. By overspending unnecessarily on loyal customers for what is needed to retain them. So you gave them all this extra price discounts, coupons, offers. They were going to buy the same volume and mix anyway without any of that. So you basically wasted money. But you can also destroy shareholder wealth by underspending on marginally loyal customers and risk their defection to a competitor, because you haven't been giving them any attention. You've just been taking them for granted. Whereas other competitors maybe have special services or basically. So we've got to be careful about how we're spending our money. Therefore, what is the optimum spending level for differentiated services to different micro segments of customers? And the CFOs and accountants that have successfully implemented customer profitability using activity-based costing, they have basically helped their team basically answer those questions. Now, here are, again, more examples of how to make customers more profitable. I will go through it really quickly. You can manage each customer's cost to serve so you don't reduce it to a lower level. There's that surcharge fee, extra fee for the extra work. You can reduce some of the services for some of the customers, focus on the labor-intensive one. It may not have any impact. The customer may not even know. You can introduce new products and service lines, abandon old products and service lines, raise prices, but be careful there because of elasticity. You raise price and a customer may go to a competitor. Start streamlining some of your internal business processes. So that's where lean management, Six Sigma quality comes into play. Increase your investments on activities that customers show a preference for. So basically give that a little bit more. And then upselling and cross-selling, as I gave the example with the golf clubs. And then you can discount prices to gain for low cost to serve customers. So what's really happening here is there is a shift, if you will, in the source of return on investment from, if you will, tangible assets to intangible assets like information. And what this diagram is showing is that as we go from data to information to knowledge to insights to decisions, return on investment from information grows exponentially. The problem is many companies are stuck in the one bubble to the far left, raw data and standard reports. That's all they have. All that they can answer is what happened. Now, in some cases, the third red bubble, the IT director has given some of the managers what are called business intelligence tools, or OLAP. OLAP stands for online analytical processing. These are the analytical tools. Companies like Tableau or Click or SAS, my previous employer. And what those tools allow is for managers to do drill downs. So let's say that there's an outlier on a purchase order or invoices. They can go to the invoicing system, click on that outlier and see, well, who was the customer or who was the product or what was it? They can get more insights. However, they're still restricted to only knowing what happened. Now, the enterprise and corporate performance management methods, of which management accounting is one of them, there's many of these methods. Let me just talk about corporate performance management and enterprise performance management. CPM, EPM are the acronyms. They're equivalent, okay? They basically are modeling tools. So a strategy map from the Kaplan and Norton strategy map balance core, it's a model on a single page of the strategy of the organization. Costing is modeling. Budgeting and rolling financial, it's modeling. So, and some of the methods are enterprise risk management. Think of these corporate performance management methods as gears in a machine. And when you seamlessly integrate them together, you get power and synergy. And when you embed analytics into the methods, analytics of all flavors, regression, correlation analysis, association analysis. I know some of you took those courses in college on analytics. You just wanted a passing grade and get the heck out of there. Well, sorry, analytics is here. But the good news is you don't need to go to your attic or basement and pull out your old college textbook, but you need skill sets in your organization that have capabilities with analytics. So, but here's the message of this slide. The three red bubbles on the left, all you know is what happened. Once we get to the first blue bubble, we now know why did it happen. That gives us insights. And the reason we have why is because we use cause and effect. So it gives us much more insight, the causality of it. Now we move to the next bubble. Now we're into the predictive view. The future is coming at us. The ones to the left, my automobile analogy, they were the rear view mirror of your car. You were looking at the past, last month, last quarter, last year. We get to that second blue bubble. Now we're looking through the windshield. The future's coming at us. So predictive modeling, And then when we get to the upper right, the far right, prescriptive analytics, optimization, as high as you can go. You may have noticed in my introduction, one of my co-authored books was Predictive Business Analytics. I wrote it with Larry Maisel, a partner from KPMG that I knew well and is a good friend. When we wrote that, we said, oh, this is going to be Mount Everest. This is going to be as high as it can go. And then prescriptive analytics came into play. So we're at our next polling question. Which stage in the return on investment and information, which was just the previous slide, is your organization? So this is not a right, wrong. This is just an assessment of where you think your own organization is. A, the raw data and standard reports. B, that second red bubble, data mining, query, and drill down. C, descriptive modeling using business analytics. Now we're into the D, the predictive modeling. Now we're into the windshield. E, prescriptive analytics modeling with optimization tools. I'm going to be more patient here and give everyone more time to answer this. Another more minute or two. Okay, another 30 seconds. Okay, let's see the feedback. Again, this is not a right or wrong answer. This is sort of an assessment, a survey about you and your own organization. So 35% of you, like 1 in 3, are stuck in those first 2 red bubbles. Remember, all you have is what happened. You don't have enough about why did it happen. Now, when we get to an additional 20%, which is now half of you, you have the ability to basically investigate, drill down, look to anomalies, outliers, and that's useful. Because you're going to, when you see outliers and anomalies, it's like, well, why? So it's making you ask questions. What could be wrong? And start making you think about, well, how do I fix this? But for those first 2, that 55%, you're still restricted to only knowing what happened. Now, when we get to the next 25% of you, congratulations, you can actually know why did it happen? What's causing that? It doesn't necessarily give you what to do, but at least once you know, a cause problem, you can start thinking about, just like a physician when they're basically, doing a diagnosis of you for a health condition. They can determine basically what the issue is. But now what the treatment, that's a whole next step that comes to, if you will, making decisions. So let's start concluding with a big frustration that I have, the barriers that are slowing the adoption rate. Why has the adoption rate for profitability reporting with ABC been so slow? And I have some empirical evidence on this. I've done webinars for training companies where one of the polling questions, which I didn't ask you in this webinar, but it was like, how do you allocate your overhead and indirect costs? And I give them 4 choices. Get ready for this. 90% are spreading the butter, number of labor hours and so forth, number of units produced, sales dollars. Only 10% are doing ABC. And this is as recent as a couple of months ago. So I know that the adoption rate for ABC is slow. So what are some of the issues what are the barriers and obstacles causing this slow? Well, we can start with some technical barriers that include IT related ones. One of them is what's called dirty data, low quality data coming in, data that was source data put into systems that was flawed or misleading. I mean, an example might be, and there is a tool that IT software vendors have called extraction, transform, and load, ETL. So I'll give you an example. Let's say that you're multiple divisions of a large conglomerate, and the headquarters wants to basically do a price discount with one of your largest suppliers. We'll give the example, the supplier is General Electric. But one of the divisions in their supplier database, they've got a GE. Another one's got General Electric spelled out. Another one's got GEN apostrophe L. They're all different. So you don't know how do you do the volume with all of them? ETL will come in, pick a standard, replace the standard in all of those, let's say 10 supplier vendor files, and now headquarters can actually see the real volume and go to GE and negotiate lower prices. Another IT issue is multiple hardware vendors. Some got Dell, some got Hewlett Packard, some got IBM. IT can fix that. Another problem is the perception barriers of excess complexity and affordability. I'm sure many of you earlier in my presentation, when I was mentioning ABC, you had that perception, oh, it's too complicated. It'll be too difficult. It'll take too long. Oh, it's not worth the effort. I can't imagine that the accuracy will be that much better than what we've got. No. When you use ABC, you discover that compared to that butter spreading, some of the error percentages can be 30, 40, 50%. So what I mean in US dollars, let's say a product with your old flawed method is $500. Using ABC, it's $800 or it's $200. ABC, it's really magnitude of error. And finally, there are behavior barriers that involve resistance to change, culture, and leadership. And let's start with resistance to change. It's human nature. People love the status quo, don't rock my boat, So they don't want other departments to know what their costs are. They may not basically want to know any of that information, So other barriers, fear of knowing the truth. Oh, I don't want the truth. Fear of being measured. I don't want to be measured. Fear of being held accountable, So notice those barriers are not at the organization level, they're at the people level, the human level, Weak leadership, there I said it. Not every executive team at the top basically has the highest IQ, so they're not basically effective or competent with change management. You need behavioral change management. And let me give you it's not in a slide, but if you have a piece of paper, I want you to write this formula down. D times V times F is greater than R. So in parentheses, D times V times F, close parentheses, is greater, the bracket, than R. All right, what's R stands for? Resistance to change. It's a huge number. So you're all asking me, well, Gary, what's D, V, and F? Well, I'll tell you. D stands for dissatisfaction with the current state, discontent. Unless people are unhappy or have some pain, they're not looking to change. V stands for a vision of what better looks like. So if you got significant D, significant discomfort, they're looking for the solution, the V. They're looking for the lifeline in the boat. So you would think, well, if I've got significant pain and I've got solutions, V, like activity-based costing, I'm home free, I'll overcome the resistance. But F is the sleeper of the D times V times F. F stands for first practical steps. Because if they think your solution is overly theoretical, overly complicated, overly, if you will, whatever, unaffordable, they're not going to proceed. So in the context of this whole presentation, D stands for basically learning that we've got inaccurate, flawed, misleading costs. We need to fix them. V is the solution. F is rapid prototyping with, the iterations. Here are some of the reasons. Now it's smaller print, but I'm going to go through more specific reasons, excuses preventing ABC. First one, a perception that ABC is too complicated and complex. Next, a belief that the extra efforts benefit do not exceed the administrative effort to implement the ABC system. I already mentioned to you that ABC rapid prototyping with iterations can implement it in 3 weeks, not 6 months. Third, consultants wanting lots of billable hours to construct the large and complex ABC systems where most are not understandable by their client and they're difficult to update and maintain. Next, the CFO worries that by having 2 accounting systems, the external financial compliance reporting for government regulatory agencies using generally accepted accounting principles, GAAP, in the US, that agency would be the Security and Exchange Command. And then this alternative internal management accounting for insights and better decisions. They're worried that if we basically introduce this ABC, it's going to confuse their managers. They're going to ask, which cost data should I use? Incidentally, anecdotally, I did a project for Clorox, and what the CFO did on day one when ABC says no one can use the external reporting except us in the CFO office. And then finally, a belief that the higher cost accuracy of ABC compared to the existing tradition is maybe 5% error. No, I already gave you examples. It can be 30 to 60%. So the complete vision of performance management. There is a cover of my book on the left. There's the gears. Some of them are broken, grimy, not interconnected. To the right, titanium gears, integrated, spinning faster revolutions per minute. So think of this like in your car engine. To the left, your fuel efficiency would be low. To the right, your fuel efficiency would be high. Now replace the analogy of fuel efficiency with rate of shareholder wealth creation. We want the revolutions per minute of these corporate performance management and analytics gears spin better, faster, cheaper, safer, and smarter. So thank you for coming. We're going to have a few minutes, just 2 or 3 for Q&A. But steps, get educated. Thank you. You're doing that by listening to this. Get buy-in from the others, rapid prototyping, start small, think big, move fast. And then incentives. I don't have experience with motivational theory, but it's important. That link will take you to, so your success depends on how well and how fast the right information gets to the right people. There's my email address. Hessel, I know we only have 3 minutes. Can we use them productively?
We can definitely take questions now. So far, there have been no questions about the presentation. So if anyone has a question, quickly shout it. I think we have about a minute left. As I mentioned, we do have the roundtable discussion next week. So join us. We'll have a lot of time to go really deep into the presentation or any other topics. And a few people may not have received the CPEs. If you have a problem with the polling questions, just send me an email. I put my email in the chat already. Okay, we have one question from Francisco. Thank you very much. Do you think AI will facilitate ABC introduction?
It's in its early stage. The example, and I'm inquiring of others, one method might be that it could create the activity dictionary. So AI for an industry, so banking, insurance, distribution, whatever the industry, the AI could go look at that and say, well, here's the work activity dictionary of the employees in the cost center. It's at an early stage. Hessel, I'd like to make since there's no other question and we have 1 minute, I'd just like to have a concluding remark here. I think in the past, the best leaders and the best executives had the best answers. Today, I do not think that's the case. Today, I think the best executives and the best leaders have the best questions. There's too much complexity. There's too much volatility. There's too much uncertainty for them to basically rely on the types of answers they had earlier in their career when they were younger and got promoted to these higher positions. They need to create a culture of investigation and discovery. So I'm putting a real emphasis that questions, being not just curious, but having questions is key to improving operational performance and financial performance. So Hessel, your concluding remark, I'll end on that. Thank you very much, everybody, for attending.
Thank you very much, Gary. Thanks, everyone.